I mean, we'll talk about silver first. Silver, there's no doubt about it. There is a liquidity squeeze. And in fact, in both gold and silver, we've got this extraordinary situation with metals going into new high ground or not far off it, definitely in bull markets. And the speculative interest on the buy side, as it were, is minimal. I mean, if you look at the open interest on COMEX for gold, that's less than 420,000 contracts. I mean, that's sort of oversold level. I mean, not deep oversold, but pretty near it. And this is the fascinating thing. Gold and silver are rising without any speculative input. I mean, it's obviously a little bit, but I mean, it's tiny, if anything.
Something happened in the silver market that almost nobody is talking about. And yet, it might be one of the most important financial events of this decade. Imagine this. A rumor sweeps through Shanghai that someone is preparing the largest stand for delivery the West has ever seen. Hours later, more than 36 million ounces of silver, worth over $2 billion, are demanded for immediate delivery on COMEX. Not rolled, not closed, not postponed, demanded. And right after that, the COMEX system suddenly fails, goes offline, and blames a data center overheating issue, something that engineering experts say is almost impossible because these systems have triple-layered backups. But here's the part that should make every investor stop and think. Silver and gold were already rising before this happened, even with almost no speculative traders involved. A market rallying without speculators means something far deeper is driving it. And if you connect the dots, falling inventories in Shanghai, shrinking COMEX stockpiles, collapsing London liquidity, and China banning silver exports starting January, you immediately understand why Alasdair Macleod says the silver derivative system is now in its final phase. What just happened isn't a blip. It's a warning, and maybe the beginning of a much bigger shift that will hit the entire global financial system.
I mean, it's really a squeeze on the establishment, on the paper establishment. And I think that, particularly in the case of silver, it's very difficult for the establishment actually to close out their positions. And consequently, we could be seeing, if you like, the end of the silver contract in both forward markets in London and also on COMEX. Now, that's quite a statement because so long as I've been looking at the relationship between physical and derivatives, there have been gold bugs saying the derivatives are used to suppress the price of gold, suppress the price of silver, and so on. I mean, undoubtedly that is true. But if that's coming to an end, then there is going to be massive buying pressure from that end alone. As people move out of paper, where they've got paper and they think they've got exposure to the price, as it were, they'll move out of paper and have to move into the physical. So I think we're seeing potentially momentous events. Silver could be breaking, if you like, the commodity derivative system. And that's a fascinating thought.
If it's not retail buyers taking this thing up higher, who is?
Well, this is the point, Danny. It's not buyers doing it. It's basically the shorts refusing to go even shorter. They're trying to control the position. And worse than that, they're finding the few buyers in the market are standing for delivery. I mean, there's a fascinating thing which happened last week, I think on Thursday. There was a story apparently going around the Shanghai Gold Exchange and the Shanghai Futures Exchange that there was going to be a large stand for delivery in Western capital markets.
Yes.
And there was actually, as it turned out. We're talking about 36 million plus ounces of silver in a stand for delivery on COMEX. And coincidentally, the whole of the COMEX system had a data fault. Now, did they pull the plug because they couldn't resolve the situation? I mean, we're talking about a delivery of $2 billion worth of silver. This is large. There was also a very large delivery of gold, over 58 tons on that same day. So, I mean, I think the markets are showing huge, great strain. Now, the fact that the rumor started in Shanghai rather suggests that the stand for delivery was of Chinese origin, or at least origin in that part of the world, and was known in that part of the world. I mean, I could certainly see, someone standing for delivery like that would be quite happy to talk to his chums, if you like, and say, guess what? I'm standing for delivery for $2 billion worth of silver. And I reckon that that's going to tip the market up, or whatever I say, but you can see how the rumor might start there.
Yeah.
And confirm, if you like, that it's Chinese sources who actually went for it. But the other thing that's fascinating is, was it just coincidence that a data center had to shut down because it was overheating? No, I read somewhere by someone who is supposedly an engineering expert on cooling systems that data centers like that not only have one complete backup system, which automatically switches in if the principal one fails, but usually they have a backup to the backup. So this failure system is a bit fishy. So could it be that the powers that be just pulled the plug on the whole system while they tried to sort it out? I mean, the problem with this is that, of course, we're not just talking gold and silver. We're talking about virtually the whole of the CME shutting down, if you like, by either having the plug pulled or through a data system fault. So it's all very mysterious. It really is mysterious. I mean, what I would say is that one of the primary functions of the system, the establishment, is to ensure that if something like this goes wrong, we are not to know about it at all. They will sit on it. They will claim anything to ensure that it doesn't leak out into the public that someone is in trouble. Because if someone's in trouble, we start worrying about this, that, and the other thing. I think we're probably beginning to do that anyway when we see the stands for deliveries. I mean, I haven't actually, ahead of this, looked at my numbers, but I think we're looking at about 12,500 tons of silver this year, 12,500 tons of silver this year, and roughly 1,200 tons of gold. I mean, these are huge numbers. The COMEX has turned out to be the largest precious metals mine in the world by, 3-4 times the largest mining nation. I mean, this is a staggering development. It really does.
What happened to that $2 billion order? Did it get fulfilled?
Well, no, it was a stand for delivery. Basically, someone bought the December futures. It's all on the December futures. And instead of closing the thing out and rolling it into the next one, which is normal practice, if you like, they said, right, come on, we want that stuff. Deliver, as they have the option to do. This is an extraordinary thing. It doesn't necessarily leave the CME warehouses, but the point is that the ownership changes and it goes into firm hands. It's no longer available as liquidity in the market, being registered for delivery. Comes out, that's it, tough. And in London, of course, there's no liquidity at all, which is why there's been that backwardations. And I think the reason that the backwardation has gone is principally because we're rolling over into the March contract now. So there is a time factor in there, if you like. I haven't actually done the calculation to see exactly what.
The silver market today is showing signs of stress that we've never seen all at once. For months, silver has been rising without heavy speculative inflows. Open interest on COMEX is near oversold territory, yet the price keeps climbing. This is extremely rare because it means the rally is being driven by something other than leveraged paper traders. Alasdair Macleod explains why. The shorts are refusing to go deeper. The long-side buyers who do remain are standing for physical delivery, and the system is running out of the metal needed to settle obligations. That massive 36 million ounce delivery wasn't an accident. It was a signal. And the timing of the COMEX shutdown, happening minutes after the stand became visible to the market, looks less like coincidence and more like a desperate pause button to contain panic. At the same time, the physical supply backdrop has become historically tight. Shanghai Futures Exchange silver inventories have fallen below 600 tons, the lowest in nearly a decade, and widely seen by analysts as a danger threshold. COMEX registered silver has been drained to around 27 million ounces, one of the tightest levels in modern history. London's LBMA vaults, which for years acted as a giant buffer for global silver flows, are now more than 35% below pre-2020 levels. Those three major hubs, New York, London, and Shanghai, are shrinking together for the first time. But the real pressure is coming from industrial demand. Solar manufacturing alone consumed more than 190 million ounces this year, an all-time record, while EVs, advanced electronics, battery tech, and AI chip production continue accelerating. Industrial users are now hoarding silver rather than releasing stockpiles back into the market. That flips the entire supply-demand dynamic into something Alasdair Macleod calls a Giffen-like phenomenon, where higher prices actually make available supply drop even faster. Add to that China's decision to ban all silver exports starting January, and the West loses its key balancing source of physical metal. And through all of this, silver ETFs in India have already suspended operations due to metal shortages, creating fears that Western ETFs like SLV could eventually face similar strain. This convergence, falling inventories, growing delivery demands, strained ETF systems, industrial hoarding, and China withdrawing supply adds up to exactly what Macleod has warned about for years, the endgame of the paper-silver system. The derivatives market cannot function without a reliable pool of deliverable metal. The moment those ounces disappear into firm hands, the system becomes unstable. And right now, more metal is leaving than entering. According to Macleod, the message is simple. The silver isn't there. It's gone.
It sort of rather indicates in terms of, whether this is a backwardation once you allow for financing costs and all the rest of it. But, I think the point is that there are huge shortages everywhere. Whether it's COMEX or London is immaterial. And incidentally, also, the shortages seem to be in Shanghai because the silver stocks have gone down. I mean, they're under 600 tons now, which is seen rather as a Rubicon figure. I mean, if you go underneath there, you've got problems. It's also worth noting that from January the 1st, China is banning the export of silver. Now, that's interesting because China has been, in my view, the swing factor in controlling prices in the West until very, very recently. So if they're withdrawing from the market completely, there is no lid on silver, none whatsoever.
Who's the kind of person or entity that would stand for deliver to the tune of $2 billion in silver?
Well, I mean, in China, it could be a speculator. I don't know. But the majority of demand, I mean, almost all the demand at the moment is actually industrial. We're seeing the gold-silver ratio drop. But the idea that, Joe Public is sort of thinking this is a cheap way into the gold story. Gold's gone. We've missed that. We've got to get into silver. It's got a big catch up. The story basically is fiat currencies are in trouble, and therefore silver will return as a monetary metal, good and proper. I don't think the public are buying that at all. I really don't, not yet. And I think that the squeeze is really the result of years of greater supply than mine demand was, could satisfy. And it's just sort of caught up with things a bit. So a lot of this move it's rather like, when you get a dislocation in the market, the price just goes crazy. We saw this with nickel on the LME, was it 18 months ago? In that case, it wasn't a shortage of nickel. There was a shortage of deliverable nickel because the nickel had to be delivered, if you like, in accordance with what was required under the LME contract. And it was a Chinese nickel business which had loads of nickel, which it could have delivered, but not in that form. So it reneged on the contracts. And of course, the LME then had to sort of strike out any contracts that were taken out over that period. In the case of silver, it's different. It's not there. It is not there. It's gone. It's as simple as that. And of course, the other thing is that any industrial entity which has got a stockpile, is it going to let it go? In the past, it might have traded a bit, but under these circumstances, oh no, certainly not. We're going to hang on to our silver because we won't get it back if we put it into the market. So it's almost become It's a Giffen good. I've written about this a few times. A Giffen good is one which sort of upends the normal supply and demand relationship being sorted out by price. Price rises and, supply increases as a result. No, what's happening is that as the price rises, the supply is diminishing. And that's having a catastrophic effect as far as industrial users are concerned. And of course, it's only just beginning to catch the attention of people in the markets who are sort of thinking, should we speculate by buying silver? Should we buy silver ETFs? I mean, we saw Indian ETFs suspend operations back in the beginning of October because they couldn't get any metal. You could easily see the same sort of thing happening with ETFs in the West. SLB and so on and so forth. They may be forced to do that. I don't know. There's just no silver. I think that's the point, Danny.
If the trend continues, we could see the biggest shift in precious metal pricing since the 1970s. Silver has already surged more than 100% this year. Inventories are shrinking. China is stepping away from the global market. Industrial demand is exploding. And now we're seeing massive delivery demands breaking through the paper system. This is exactly the scenario Alasdair Macleod has been warning about. When physical silver finally overrides derivatives, the true price emerges. Here's my question to you, and I genuinely want to see your answers in the comments. Do you think this $2 billion delivery was a warning shot from a major player, possibly China? Or was it simply the first crack in a much bigger collapse of the paper-silver system? If you're following the gold and silver markets and you want real data, real analysis, and real global context, not hype, then tap that subscribe button right now. We're at the start of a financial story that could redefine wealth for an entire generation. I'll be here breaking down every major move, every inventory shift, every policy announcement, and every sign of stress in the system. Stay close, because this is only the beginning.